Hey, welcome to Advisors Lodge, a podcast for all financial advisors. I'm one of your hosts, Edward Pai.
And I'm your other host, Roger Ling. Join us as we chat with industry experts to get the best advisor tips and ideas.
Good morning, everyone. It's great to have everyone back on this podcast again. Today, I think a very interesting topic. One thing is that it wasn't long ago that investors earn practically almost zero returns on their cash. But I think in today's world is a little bit different, right? Many people, in fact, has been very comfortable holding cash, of course, because of the high deposit rate. So today, what we are going to discuss is that, how can, advisors out there like yourself convince your clients, to look beyond cash and start investing? Because I think there has been many articles out there in Bloomberg, on CNBC, that, a lot of experts are, now warning that it's possible to get too comfortable with these super safe returns, and you might actually miss out on the bigger markets return. So in today's episode of Advisors Lodge, we are going to break down this topic with none other than Yvonne Lim, Wealth Advisory Director and Certified Financial Planner from Financial Alliance. Welcome, Yvonne.
Hi, Edward. Thanks for the introduction.
I think my very first question for you, right, is that
Mm.
deposit rates really attractive right now. But I think couple of months back, our bank, UOB Bank, actually was the first local bank to cut the rates, and then now the rates are falling. If I'm not wrong, it's about 2.7%. I think that's what I understand from the last I've checked. So, since the rates are dropping, are the people or your clients ready to return to investing? What are you seeing in the markets? Yeah.
I think on the ground, my clients have actually started asking if we have alternatives to fixed deposits and your Singapore saving bonds and your T-bills. So I think the interest is really picking up. So that is what I've experienced. And if we look back in history, when all these FD rates or saving rates drop, there is a trend of increased interest in like equities and other investments like REITs, so on and so forth. And I think we already see in the news, right? I mean, there are like data saying record inflows to equities and REITs, so on and so forth. So the interest is definitely there. Whether they take action now or not is another thing altogether lah. Yeah. Personally, I do think that what's interesting, right, is to observe if the non-investors are actually willing to start considering investments. So I think that is the more interesting area for me.
So thanks, Yvonne, for joining us today. I think it's about time, I guess, over the last 2 years when the rates have been rising, and then right now I think I just came across an article and a social post by one of the community forums saying that rates are falling. So it's interesting to hear from you that the investment is one of the consideration. So as an advisor and an experienced advisor like yourself, right? How would you actually persuade people to actually consider investments when the risk jump is actually quite I wouldn't say it's big, but it's a little bit different because they are used to the guaranteed portion and looking at right now it's about 3-ish percent cover use. But how do you actually encourage or even start introducing investments to your clients? Yeah.
I think one thing we need to realize is that everything in life is relative. Happiness is relative, satisfaction is relative. Back 2-3 years ago, we were very conditioned to accept savings rate, fixed deposit rates, short-term endowment rates that were giving like 1.8%, 2%, and people were happy about it. But over the last 2 years, the interest rates have been very high, right? And people are enjoying the 3%, 4%, and they have tasted this sweet fruit of the high interest rate. Just like 2 weeks ago, my mom called me her FD matured, and she was like, Yvonne, I actually received this amount of interest from my FD. So she was very happy about it. So if you think about it, as interest rate falls, will people really be like satisfied to go back to 1%, 2%, 2.7%? I personally don't think so. So I would like to think that the convincing shouldn't be too difficult with clients, especially because they have experienced how it's like, how fast their wealth grows. when they have a higher interest rate. So that is what I think would happen. And other than that, I mentioned endowment plan briefly just now. The rates on all these savings plans have also trended down over the last few years. In fact, when FD rates were high, the saving plans rates were relatively low. And unless people commit for a much longer time frame, it's difficult to get anything that's above 4. So that is the first point, whereby I think that people realize that having a higher return will help their wealth grow more strongly and quickly. So that I think would help persuade people first and foremost now.
But I agree. I think that's also something that is on top of their people's mind as well, because the rates they were accustomed to it. People get used to it, they get pampered and so on and so forth. So I mean that is great to hear that, even from the endowment side of things, the rates are also trending down. So practically the solutions are getting narrower and narrower.
In that case, right? I mean, investors, they're getting used to this safe investment, but like what you say, rates are coming down. A Fed is going to basically, there's a high probability of actually cutting rates, and clients who are basically very used to fixed deposit or rather risk averse. Actually, what is their next step? Once all these rate cuts come in, what type of solutions, probably are you recommending to this type group of clients, or how are they going to actually manage basically their growth in their portfolios? Yeah.
I think because I'm a certified financial planner, right? So a lot of times I plan with everything of their objectives in view. So first and foremost, I need to know what is their financial objective, right?
Right.
And will the current low rates, if they were to go back to 2 to 3%, would it allow them to reach their financial goals? Like, can they retire comfortably if they save 2,000 a month until retirement? Are they able to retire with their desired lifestyle? If they tell me that they can't, and then they can't save more to reach that goal, then obviously we have to seek higher yields, which is basically, as we mentioned, it's getting narrower lah, which is equities. It could be equities, fixed income, or it could be REITs. So there are all these options that we can use to help them increase their rates from say 2 to 3% to say 4, 5, 6, 7 and beyond. And the whole point of using all these vehicles is because we need to hit their financial goals. And it could be different for everyone, right? Some people need to have a higher return because they have aspirations of estate creation. Some people may just think that, oh no, I want to save for my kids' overseas education. Or even if they are very, very conservative and then say, oh, I just live in HDB here in Singapore, we still need to take into account that, you guys probably have heard many times inflation is going up. So 2 to 3% is not an option. We have to explore other solutions that gives higher rates. And equities is the first solution that comes to mind, in my opinion.
Yeah, I think I probably agree with you. I think one thing that I kind of take away from what you have actually mentioned is that, markets go through cycle, right? Be it low interest rate, high interest. I think if you look across 3, 4 decades, you probably will see all these kind of markets movement. But for end investors, what we must not forget is that we have a financial objective to meet, right? And those are probably long terms as well. And as a financial advisor, I think it's very important to always remind your clients, right, to stay focused on your financial objective, because there will always be noises in the market. And of course, what you do is probably give guidance when markets are moving, how you actually position your portfolio to meet those financial objectives. I think that's a very good way of trying to tell your clients, hey, look, these things happen in the market, but you just have to stay focused for your financial objective. And from there, we actually move based on your portfolio, based on your risk profile. I think that's the way that we should actually move forward.
I think one thing is that we really do have to educate our clients on the current environment also, because I mentioned inflation right now, right? I mean, back 2-3 years ago, mortgage rates were also very low, right? I mean, UOB had like 1.1%, 1%, some foreign banks had like 0.9%. And we are way past that
Correct.
level.
Correct.
If with the mortgage rates at like 2.8, 2.7% right now, if we are just really earning 2-3%, we are not growing our wealth at all, right?
Exactly.
We are just meeting all these obligations. And likewise, inflation and medical insurance, right? This was in the papers all this recently. Like personally for me, I'll be paying $500,000 in premiums from now until age 99 if I live to age 99. But I mean, there are all these costs that we have to take into account. And it all tells us, I mean, I will educate my clients to say that 2-3% is basically not enough. Yeah,
That's
to
right.
really meet all
Yes.
these obligations. Even if you are very conservative or like you have a very conservative lifestyle, simple lifestyle, basic needs are basically growing at a big rate.
Correct. Moreover,
Mm.
you are living in one of the world's most expensive city. So I
Correct,
think
correct.
even being risk averse might not be able to help you cover some of those costs, right? So you do need a little bit of a bump up in your portfolios. Yeah.
But end of the day, it's about the clients, right? They tend to overlook what kind of besides the numbers that they're looking at, they want the highest yields, but yet again they don't want to take too much of a risk. To be honest, I have met I mean all my own friends and all that. They were telling me that they've seen a lot of products and solutions that are offering extravagant numbers when it comes to the yields. But then when I asked him, the first thing is that are you able to sleep well at night? I don't know if anything were to go bust, if you are down on 50%, how do you accept it? Then that's where reality hits. But how do you try to find a balance between the solutions that you're recommending vis-a-vis the risks that they are willing to take?
I think first and foremost, right, nobody likes to lose money on investments. I'm sure you don't like also, right? Like even after like being investing over the last 13, 14 years, when I look at my own investment, the portfolio volatility, I also feel sad on some days. So, but the thing we are really talking about, the risk averse part of things, is really how much or how well the person can tolerate the volatility of the portfolio. So you mentioned something really right. Amy, if a person invests and they can get high returns, but they lose sleep at night, then I don't think it's worth it. The last thing we want to lose is our mental health just because we are trying to grow our wealth. It doesn't make sense. Right? So for risk averse clients, if my clients come to me and say, Yvonne, I've not invested before, I'm scared to invest, but you are right, I need to beat inflation, I need to beat my mortgage rates, then the first thing I will do for them is to manage their volatility, manage the portfolio volatility. And before I even talk about solution, I would talk about the amount that they are trying to invest. If they have, say, 300,000 or 500,000 idling around, I would say start small. We start at 10%. Instead of investing 500K, let's invest 50,000. Everybody needs to go through this learning journey, I feel, including the emotional part of investing. So that will be the first thing I actually do for them. The second thing, we will go down to the solution. So typically for such clients who don't like the volatility of the portfolio, I will recommend a portfolio that maybe consists of maybe just up to 60 or 70% stocks or equity funds, or whichever it is. The reason is because at the very least, in such a manner, right, I have some leeway. I can put the 30% in short duration bond funds. And if there's any market volatility, I can rebalance. Because if I were to go back to my client and say, hey, your portfolio dropped 30%, can you invest more? I think she'll be crying by the corner because she's already risk averse to begin with. So by crafting a portfolio with just 60-70% equities, it gives me the management, the ability to manage the portfolio for her. And it also, reduce this volatility on her part. So when she locks in, she doesn't get a shock or something and say, sorry, Yvonne, I want to sell my investment. So that's the solution that I would recommend, the portfolio allocation. The other solution that I would actually recommend, right, is to go for a portfolio that is dividend centric. Because if they are receiving dividends, at the very least, they will know that, I'm investing in companies that are making money. I'm investing in REITs that are earning rental and they're giving me the dividends. They won't think that, oh, no, it's just a number on a paper that they, can't believe. At the very least, they have that, faith that, oh, no, I can rely on my dividends. Even though the market, the capital fluctuate, I have my passive income. So I feel that it works for a certain group of clients and it's suitable for a certain group of clients. And after I've done these two with them, then maybe we can talk about expanding the portfolio, injecting more funds, and going to a higher equity allocation, perhaps. But that's subsequently. So these will be the two main solutions I recommend for them.
Because I think one thing is portfolio management is always very important. right? Even for
Yeah.
my own self also, I think that's how I actually manage my own portfolio as well, right? So when the markets are volatile, you probably move to a particular asset class to kind of mitigate the
Mm,
risk, and when the markets are basically on a nice run, right? You actually leverage on
mm,
that, or you try and always rebalance things around. I think that's very key, because
mm,
like what you have mentioned earlier, financial objectives in the long run doesn't change, right? You got to save for your kids, for your mortgage, so on and so forth. Those things doesn't change, so you still need to grow your portfolio. So I think you have given a lot of pointers, you have given a lot of wisdoms of words, but I would really like you to basically share a real success story of how you actually advise a client who was not familiar with investing, but basically start to invest and kind of gain what the reap that he the seeds that he basically planted lah. Yeah.
mm. Okay. One actually, I actually had a recent case, not
Oh,
recent,
nice.
last year.
Okay. Yeah.
The client was very, very, I mean, she's very conservative. And I've actually been talking to her about investing for the longest time, like for the last 3 years. She doesn't
Wow,
have
three
the
years.
time. Yeah, 3 years. I'm very patient.
That's a good trade actually.
So she's a doctor, so she doesn't have time, she doesn't have interest, and she doesn't have the knowledge in this area that will drive her to want to invest. But she also realized that, oh, in Singapore we can't not do anything lah. So what I did for her was to do a very detailed financial assessment. So I actually really found out every piece of information that I could have gotten. Her savings in the bank, fixed deposit, the Singapore savings bond that she has, T-bills, everything, endowments, so on and so forth. And I ran simulations basically. And I'm also quite a pessimistic person. So I gave her the worst case scenario of a total loss. So I say, in the event of a total loss, are you okay? Like, are you still financially okay? And the reply to me was that, yes, actually, even if I lose every dollar of this investment, I will still be okay. So, and with that, she had that confidence that, actually maybe it's okay to take risk with just this small amount. So that was how I got her started on just a 50,000 portfolio. And it was on a dividend centric portfolio. So now she's actually very happy receiving all the dividends, even though the capital has fluctuated quite a bit over the last last 1 year lah. But she's okay because she's receiving the passive income. So that's how I managed to get her started, by really doing a detailed analysis and painting the worst case scenario for her. Then secondly, I think for clients who are really not familiar with investing and wanting to get started, my tendency is to maybe handhold a little bit lah in the beginning. If there's any market movement, I tend to update her and remind her that, all this market movement has got nothing to do with what we are investing. Half of it are just noises in the market, right? The other half is probably something that won't matter 10 years from now. So every time there is a trigger, I will remind her and I'll basically educate her again that this is just part of investing. So now, more or less, she's like quite hands off already. Like, she's willing to just let the portfolio grow. And we also craft out a solution whereby we invest a portion of her income every year. So for more risk averse clients, we sorry for because for her she's more risk averse, so we just invest a small part, just 10% of her income every year. So that's what she's doing on a monthly basis through dollar cost averaging. So that's what I've done for this particular client.
Oh yeah, I think it sounds good. I think one thing that you say, oh, 3 years you've been talking to her about investing. I think it's not only
Yeah.
patient. I think you have the grit as well. You constantly tell her about investing, and I think that's good because I think one thing is that a lot of risk averse investor, in fact, they always try and think the worst case of scenario. What if I lose? But in fact, actually, if you put to them in a logical sense, like what you have did, a very detailed kind of planning, they kind of realize that, oh yeah, it's actually only a small part of my
Mm,
basically my net worth or your income, right? So in that
right.
sense, oh, I'm actually quite comfortable with it, and that's how you get them to basically start investing. And once
Mm,
they kind of get the experience and understand the dynamics of the market bits by bits. They kind of get accustomed to it, and then of course, what happened is that they probably will be willing to actually invest more, and I think that's really a good example that you've actually mentioned. Yeah, yeah. So, really interesting topic, and I think we really like that you actually come here to share your experiences, your thoughts, and your insights. So, thank you very much for coming down and speaking to us. We really appreciate it. So, to all our audience out there, I hope you enjoyed today's session. If you have any comments or feedback, please provide us with the comments. We are more than happy to read those comments as well. And thank you. And this is Edward here signing off.
Thanks, Edward.
Thanks,
Thanks,
everyone.
Roger.
Thanks, Yvonne.
Bye.
Thanks.
Bye.
Thanks everyone for listening to this episode of Advisors Lodge.
Have any questions or feedback for us? Drop us a comment below. We love to hear from you.